Hey, Archie, would it be a good thing or a bad thing if rates went down this year?
Well, Rob, that's an interesting question. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're going to talk about something that's been really popular in the news. It's kind of a big topic of debate in the financial world right now. And that's interest rates and whether or not we'll see cuts in interest rates this year. And if we do, what to expect? What does that mean for everyday people like us? Mm-hmm. So, we've heard a ton of commentary, and the Federal Reserve has sort of hinted at this. Why is this a big topic right now in the first place?
Oh, my goodness. So if we go back to the end of 2021, we had inflation out of control. We had the beginning of the Russian invasion of Ukraine. Prices were high and seemed like they were getting higher. And the Fed decided that, as the Fed tends to do, is to jump on top of the inflation, try to get it under control. So they began raising interest rates. They hiked them a bunch very quickly, broke a few banks in early 2023, and set off not only a bear market in stocks, but also like a once in a couple of generations bear market for bonds. So the price of bonds and yields tend to move in opposite directions, kind of think of like a teeter-totter. And so it was a 2022. If you're watching this and you have any investments in your 401k, it was a bad year.
Yeah.
And they continued raising interest rates into 2023. But just on the chance that the Fed would stop raising interest rates and at some point cut them, we began to see interest rates and yields come down, bond prices come up, the stock market rallied. It was a terrific year last year for stocks and bonds. And so here we are sort of in the first quarter of 2024. There's been a lot of talk about what's the Fed going to do with interest rates? Are they finally going to cut them? Because we didn't get the recession.
Right. And inflation has come down quite a bit. And so, the Federal Reserve has what's called the dual mandate, which is they have to keep inflation low and unemployment low. And so it's kind of one of their two primary functions in society is to manage inflation. So inflation's come down quite a bit since the summer of 2022. And they've started talking about, we're starting to see maybe cuts on the horizon. We'll bring rates back down.
The bookies are out.
Yeah.
Right? They're thinking, we're going to get one in March.
Right. And again, the market has sort of come back thinking, okay, things are looking good with inflation. We'll probably see rates come down. But a lot has changed in the environment for ordinary people, whether it comes to investors, savers, people who are looking to buy something, take out a loan. A lot has changed. And, the environment kind of flipped upside down from where it was in the last 15 years. So let's start with savers. I mean, one of the first things that was sort of surprising to people in my experience talking to people who are saving was, whoa, I'm actually getting interest on my savings account. And, what's this thing called a CD? I forgot about them. They were so lame for so long. Now I can get 4 or 5%, even more potentially on a CD when interest rates kind of peaked out there. So for savers, what this may mean is that the days of really attractive interest and kind of letting your money sit in cash and accumulate interest, they may be a little bit more short-lived than we'd hoped. So,
if interest rates and yields drop, right?
Right.
I've started to notice, Archie, that in shopping for CDs for clients, that where 6 months ago we could find a 12 or 18 month CD at 5.5%. now I'm seeing that at 12 months, it may be 5 or a little less
Right.
with a call feature,
Right.
meaning that if the bank wants to pay you out early, they can.
Right.
And that is because I guess banks are betting that interest rates will be lower. And Wall Street's betting that interest rates will be lower
Right.
this time next year than they are now.
Right. Right. And so these attractive rates are probably going to go away if the interest rates are cut, and you'll see it too in money market mutual funds, money market deposit accounts, and high yield savings accounts. You probably have noticed, like many of us, that you're getting ads for high yield savings accounts all of a sudden, and they're 3, 4, 4.5%. Those tend to be pretty quick to change, right? Because the bank wants to pay you less, so that because they're able to charge less in interest for their loans, mortgages, and that kind of thing. Speaking of mortgages, that's another area that has been flipped around in the last year, where we saw mortgage rates go quite high.
Did they get up close to 8%?
Close to 8%.
They're about
now,
1% lower now, though, aren't they?
Right.
For 30-year conventional.
Right. So there was a whole bunch of it was a weird dynamic in the housing market where prices went really, really, really high when there was lots of cash, interest rates were low. Housing prices went really high. And then interest rates came up and people stopped, selling their houses to hold on to their lower interest rates. So there hasn't been much activity in the housing market. So finding a house, if you're looking to buy, has been a more challenging issue. And so what we may see for people who are looking to buy a home is, one, you can get a mortgage for cheaper if interest rates are cut. And two, that may entice more people to sell their current home and move.
Because they don't want to do that, because they don't want to give up that low interest.
Yeah, they had a low interest rate.
Yeah.
And so why sell your house if, you think, well, interest rates are high, I'm going to be locked into a higher payment if I sell and have a new mortgage. So that may change, where people might actually be more open to selling because their mortgage payment wouldn't be considerably higher.
What about the stock market? If interest rates go lower, I mean, when interest rates went higher, the stock market
went down. Right.
What's going to happen if interest rates go lower? Would the reverse be true?
Probably. So now, the stock market is an extremely difficult thing to predict. Anything in the capital markets is extremely difficult to predict. In 2022, when interest rates went up, there was a lot of fear about recession. Well, this might tip us into a recession. That might hurt stocks, these companies, that might hurt their ability to earn the same kind of profits and grow their profits, thus hurting stock prices. Now, if interest rates fall, we may see an environment where money is cheaper, right? Businesses can borrow money to grow much more cheaply, and so we may actually see growth in the stock market.
Unless the reason the Fed cuts rates is because we've entered a recession. So
Right.
it's like it is truly very complicated. But I will tell you that there are certain industries that benefit from lower interest rates more than others,
Right.
and are hurt more by higher interest rates than others. So think of the sectors that performed the poorest in 2022 would be technology and real estate, like real estate investment trusts, clobbered. When yields and interest rates go lower, they may be more likely to benefit more from that. And just the hope of lower interest rates in 2023 pushed the big tech stocks through the roof. Right. So,
Yeah. And so we may see that. And there are other factors at play, right? When you think about what could happen in the stock market or in the bond market, there are so many things to consider, which is why we don't advise trying to make predictions. This is really more about awareness and setting some expectations around one aspect, one big driver of what goes on in the markets, right? Which is interest rates.
I wanted to, as you were talking there, Archie, it made me think of so many people have really embraced the idea of cash equivalents that pay an interest rate, whether it be, CDs or, money market funds, as you talked. If you have a CD, if you buy a CD and you lock that up, and interest rates move substantially lower, for a period of time, you'll be earning interest at a higher rate than the rest of the market is. But when you go to renew that, you'll be renewing it at a much lower rate. So it could be argued that cash equivalents aren't a great place to be right now if, in fact, we're on the precipice of this cliff where interest rates and yields go lower. What will perform well if interest rates go lower are bonds, high-quality bonds. Municipal bonds particularly. So if you're thinking of am I best allocating funds, and you've pushed a lot of your money into cash equivalents, that's probably not where they should have been anyway, really, if you're trying to invest for the long term. But this might be a time to consider rebalancing your portfolio and getting back to that asset allocation that's built for a long-term strategy if your goals are long-term, which may mean taking some of that cash and actually buying bonds again.
Right. Yeah, and this is like you said, if these rate cuts are coming.
And they're not a lock. It's not guaranteed.
They're not.
In fact, we saw inflation numbers come in a little hotter than expected.
Right.
And in February, and we saw the market drop back a little bit. So
yeah, and if we continue to see that, we could see the opposite of all this. We could see, if it were bad enough, it's not unrealistic to think, well, maybe we'll get more rate increases.
That happened back in the early 80s, right?
Yeah.
So we had this runaway inflation. Mortgage rates were up. I think my first mortgage was 12.5%.
Yeah.
And that was at the end of that period of time. The Fed got inflation under control, and then they took their eye off the ball, and it came back with a vengeance. So there were two bouts of inflation, and it took Chairman Volcker was running the Fed at that time. He had to just really clobber it, raised interest rates through the roof, which would be bad, and finally, it was brought under control. So just because it looks like things are trending better right now with inflation around 3%, that doesn't mean that the wheels couldn't fall off and we could end up with more interest rate increases. So it's, take all of this in stride and understand that there are so many factors at play.
Right. And it's like you said, if you've made major changes to your strategy, shifting into cash equivalents, we're talking about money markets, CDs, short-term treasuries and things like that, or savings accounts. That may not last forever. And generally speaking, over the history of the capital markets, cash hasn't outperformed inflation, right? There may be periods of time where you get a little edge. But in the long run, it doesn't. And so it hasn't. And so keeping that long-term approach in mind and not subjecting yourself to, in the industry, we call it reinvestment risk, where you don't get the same rate, next time you go to roll into a new CD or into a new treasury, or your money market fund just pays less and less and less interest over time.
Scenarios where you want to have that cash. And that's for your short-term needs.
Yeah.
Like for your emergency fund, maybe you like to have interest-bearing cash equivalents for 6 months or even longer, a year's worth of living expenses, so that you don't worry so much about what the markets do. That's a great use for that as that type of asset.
Right.
But longer than that, have that balanced portfolio and rebalance it periodically.
Right. Yeah, absolutely. Yeah, it's so important. And being patient and being careful, like we'll have an episode on this, but be careful what you're reading, right? Try to stick to as much factual information and data as you can, and avoid those, trying to make those
And talk to
predictions.
if you have a financial planner, talk to your financial planner if you're concerned.
Absolutely. So anyway, we hope this is helpful to you. If you're wondering, what do I do if rates get cut, and what can I expect? There's some ideas here. Again, there's no guarantees in any of this, but
shoot us questions. If you have a question, we're happy to answer it for you.
Yeah, like and subscribe, share with your family and friends, leave us a comment, and we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.